gave up managing billions to become a better investor. Episode 18, Global Investment Markets Half 1 2023 Review and Predictions for Half 2. Hello. Exciting times. We've entered July, which means two things really. One, that it's getting quite close to the summer. And the second, of course, is that we're now in the second half of the year. We've had the first complete 6-month period. So therefore, how has the first half of 2023 been for investors? How have markets done? What's been good? What's been less good? And I guess additionally, what's going to happen over the rest of this year, the second half of the year? Let's think about the first half initially. Obviously, it's been an interesting last 6 months, some good and less good matters. And naturally, we could easily talk, as I've talked about in previous podcasts, concerning matters about inflation, interest rates, geopolitical matters, and of course, concerns about debt, recessions, and everything else. Oh, and sometimes growth and profits and surprising share price moves and related. Lots of things to talk about as per usual. Let's think about it in terms of what has performed and what hasn't, because I guess that's the easiest way to kind of initially sort of look at a period of time. Over the first half of the year, it's kind of interesting, and I'm looking at these, by the way, in sterling terms. I do appreciate there are a few differences if you look at it in dollar terms or other FX indications, but you'll get the sort of general feel about what I'm trying to say, because I think it's still globally applicable no matter where you're looking from. If we look on the big winners, it's pretty clear what the big winner has been wherever you're looking from, and that has been technology. And obviously, we've seen the NASDAQ Technology Index have its best first half period since sometime in 1983, probably when they first started looking at the numbers. So that's pretty impressive, to say the least. Clearly, you've got to take it into the context of a very poor 2022, as you'll recall, for most technology companies. But nevertheless, it's performed extremely well in the first half of 2023. So that's been the big winner. And consequently, what you've seen is for the average investor in diversified US larger cap areas, markets have performed well. And obviously that's a little bit due to mix, because when you look at the NASDAQ, the S&P 500, the Dow Jones and related, guess what sector is a very significant component of those indices? Obviously, we all know it for the NASDAQ index. But when we think about the S&P split or the Dow split now, technology is super important and super influential. So, quelle surprise, the reverse of last year again, when we have seen strong performance by the technology sector, it's done rather well for heavy sector components of those indices. And of course, as you may have seen in recent days, we've had things such as important stocks such as Apple have now moved above a $3 billion market cap. So consequently, $3 trillion market cap. Get the numbers right. I think many companies above 3 billion. 3 trillion is a little bit more impressive. But consequently, it's been a very focused market in the sense that heavy components of the NASDAQ and the S&P have done rather well, and consequently those indices have done rather well. But obviously, when you look at it from a much more active or diversified perspective, it's not been as good. Clearly, we've had some local difficulties, particularly in the States, in parts of the banking sector, and other sort of areas of uncertainty too, which we'll talk about in a few moments' time. But nevertheless, for the average global investor accessing, I guess, well-known US indices, certainly ones with a passive orientation or ones where technology has been an important component of the underlying investment product, 2023 half one has done rather well. What other areas have done okay? Well, you won't be surprised to know that Japan's also done well. You may recall there's always a little bit of a correlation between certain parts of the tech sector doing better and Japan doing okay. Again, a not insignificant component of the Nikkei 225, not as sort of impactful proportionately as what we would see in the NASDAQ or even the S&P 500, but nevertheless, a positive element there. And you may recall that Japan has gone above to new highs for the last 30 years in recent times. But as we talked about in a previous podcast, not particularly impactful or kind of insightful, given the fact that Japan's had such an awful market since the all-time highs of 1989 and related. We're still not back to those absolute high levels, but nevertheless, Japanese stocks have done well. You may have seen, though, that the yen has been a little weaker against many currencies at a multi-year low against, for example, the euro. And again, that's an interesting indication. But nevertheless, when I look at it in my sterling piece of analysis, despite the fact the pound's been okay against the yen, the Japanese markets have done rather well year to date too. Again, kind of, you just got to take out a little bit about some of the sector shifts. I'm sure some people will say, because Warren Buffett's investing there, suddenly the market's become of more interest. I think it's a bit deeper and wider than that. But nevertheless, Japan has done well, perhaps surprised a few people year to date. But again, you look at last year, you look at much of the last 20, 30 years, you wouldn't be coming to an akin conclusion. All you'd be saying is about time that it had a better time period, performance period. In terms of other areas, though, that have performed, Europe has done okay. Certainly been a positive performer, certainly from the perspective of larger cap pan-European equities. And obviously that's, I'm not going to call it a surprise, but it's certainly something which a year ago, investors were very concerned for obvious reasons about Europe. And clearly there's been big concerns for many years from a general economic perspective. But events last February, March in Ukraine clearly had a big impact just because of geographic proximity or relative geographic proximity with large swathes of Western Europe, and consequently European markets struggled at times last year. But as we've talked about many times before, certainly with particular reference to areas such as luxury goods, which are a not insignificant part of the European markets, it's been a very active investing focused area. And frankly, I would say certainly over the 30 odd years that I've been looking at investing in the European markets, I've always felt that it's a marketplace which is where active investment is so important. They have such a wide, diversified sector split, certainly much more diversified than the aforementioned sort of NASDAQ and S&P 500 sort of typical US indices. And so therefore, some component of recovery, sort of slightly fewer concerns about matters in Ukraine, which sadly are still not obviously fully progressed positively yet, still difficult and dangerous over there. But nevertheless, some of the impacts from Europe moving forward, and obviously all of that despite the fact that the ECB, along with obviously most other major central banks in the world, have raised interest rates, you've still seen equity markets perform relatively positively, particularly, as I said, from a large cap perspective. We'll come and talk about smaller cap stocks in a few moments' time. But Europe has done well. Again, I kind of feel it's because many global investors who were underweight of areas such as Europe and Japan last year have kind of slightly changed their views, and I think are starting to get their heads around the fact that there are always smart stocks to invest in and possibilities to do. But as always, you've got to be an active investor rather than just investing in a bit of everything. And I think there's been a little bit of a sort of an acknowledgement or realization of that. Cheaper stock prices, opportunities, geopolitics not being quite as worrisome perhaps as what we've seen in previous time periods, and certainly as if you like, it's an alternative for the American investors to perhaps a China or something like that, perhaps starts to explain why areas such as Europe and Japan have also performed relatively positively year to date. That's some of the winners. I noticed on my sort of top 10, 12 areas of performance, a couple of areas have struggled to perform. One of those has been the UK. We'll come and talk about that in a second. I do note that some of the high yield bond areas have just about moved into positive nature in the UK, which is good. But actually, the more general observation is that UK equities, smaller cap equities, not just in the UK, but in other geographies too. And a bunch of different bond allocations have performed poorly year to date. The other, and actually the biggest loser year to date from a sterling perspective of these markets I'm looking at here, was actually China and related equity markets, which again is kind of intriguing. And we'll come and talk about that in a second. But from a fixed income perspective, I think it's pretty easy to understand why there's been a struggle year to date. Interest rates have gone up, and I know that is often perceived as being an opportunity for bond investors, but it takes a kind of an adjustment period to be factored in. And as we've talked about on loads of podcasts over the last few months, the fact that there has been some inflation, we've moved interest rates or central banks have moved interest rates from near zero to something which is starting to be a little bit more normal. I would still say it's hardly abnormal levels. I know people are very sensitive towards interest rates at the moment, but believe me, when I look at, let's say, mortgage rates here in the UK, 6 and change % is nothing compared to the norms of 15, 25 odd years ago. But nevertheless, bond markets have unsurprisingly been dull, let's put it that way. And I'm not surprised to see them being generally amongst the losers. As I say, not exclusively. You can find certain areas, for example, high yield, I guess because you are being paid typically a higher rate of interest. Sometimes some of the performances there can be still a net positive despite some of the challenges year to date. Again, though, choices of bonds in that area have become super important. And I guess, unsurprisingly, something I've talked about many times before, the importance of active investment selection is clearly, patently super important in 2023. And frankly, I think it's a big 2020s theme in any case. I know what you're thinking. You're saying, well, hang on, you talked 5 minutes ago about technology doing well in the States. And actually, when you look at the SP 500, 8 or 10 stocks, all the big tech names that we could mention have done rather well, and therefore 490 odd stocks in the SP 500 could do quite poorly or do very little at all, and you still may have a positive index. And I do agree that is true in the States. But actually, as I've talked about before, I am strategically multi-year struggling a little bit with US allocations, certainly versus the 50% odd of the MSCI kind of global index split. I'm struggling with that allocation. That feels way too high to me. And consequently, I would still be cautious of US allocations. I'd be underweight, if you like, the norm, that kind of 50 and change % of the MSCI global index split that the US currently stands for. And I find more opportunities in areas such as Europe, even Japan, but certainly developing markets generally, as areas of greater, not only just growth potential, but less anticipated kind of growth potential, particularly when you factor in valuation levels. And of course, as always, as an analyst or as an investor, it can't just be on sort of top-down macro views. You've got to have that bottom-up kind of view on stock justifications, valuation angles, and related. And clearly, they're massively important too. You won't be surprised to know that this podcast is sort of part one of a two-part special series. The first about how half one has performed and some of the possibilities from a macro perspective on half two. The second podcast later this week will be about the upcoming corporate earnings season, the quarter two corporate earnings season from mid-July onwards, and all the potential insights from that. And that is much more bottom-up, stock and sector centered. And as I've said before, where you should be probably, as from a general investment perspective, be spending the majority of your money and time looking through, because in reality, that is the way to really think about investments. And again, if you're a technical investor, this is probably deeply boring, and my guess is you're probably not listening to this podcast in any case. But for all active investors, thoughtful active investors, sort of 20-30% of your time looking at macro and the balance looking at sector and stock bottom-up considerations. That is the way to be spending your time in my perspective. Certainly how I have spent my time as an investor over the last 30 odd years and how I continue to do so. And clearly it's not faultless, still plenty of challenges and problems with that. But that, in my perception, is how you actually make money as an investor. But anyway, for another time, I guess, issues I've talked about many times before, and no doubt we'll talk about many times in the future too. So the losers, some of those losers are not particularly surprising. Fixed income, China, of course, there's been, I guess, some geopolitical angst. I mean, what's interesting about the Chinese market split, of course, is that you would have thought in the early part of this year, and certainly this was my view too, that China would perform actually quite well in 2023 because Xi Jinping, I think, finally had a bit of common sense about COVID and decided that super lockdowns or another year of lockdowns was not that smart for the Chinese economy. And there was an opening up akin to the general sort of switch of events that we'd seen across Europe, America, etc., the rest of the world largely over the previous year or so. And that was, conceivably a smart thing for China to do. And I think generally that has been a good thing to do and for the broader Chinese economy. So why has the Chinese economy not performed from the perspective of the equity markets? Well, I guess part of that is interlinked a little bit with the sort of the aforementioned notion that economic growth is always important, and Chinese economic growth numbers have been a bit disappointing relative to hopes. They're still exhibiting growth levels somewhat higher than pretty much any developed market economy you could name, but certainly disappointing versus some of the levels that analysts entered this year with. So you've got to take that into consideration. I would also say that clearly some geopolitical angst has had an impact. There is no doubt that the influential American investor, and I guess when I say American investor, I mean American stroke global investor, has become more cautious about investing in China for various reasons we can discuss and have discussed before in previous podcasts, whether that is wise or not. My personal view is that I would say it's not wise. I'd say it's actually missing out on opportunity. And I'm pleased to see that not only have we seen a number of important global executives from America visit to China in recent weeks, but we've also got increasingly a few more political players in America deciding to go over to Beijing and have a discussion face to face with their equivalents in China. And I think that's smart for everybody because, let's face it, the most important way that the global economy can move forward is trade. And positive, sensible trade between different nations and different regions. And I think from the perspective of the rest of the 2020s and into the 2030s, there is still lots of scope for America and China to have a workable relationship. Perhaps for another time we can discuss the sort of the realities of which country is number one in the world over the next 5 or 10 years in matters such as that. But my observation is that generally there is still a case for Chinese investment opportunities. And I'm kind of intrigued by the underperformance so far year to date. I find that certainly when I look at Chinese stocks, and by, I guess I'm going to call it greater Chinese stocks, so including ones listed in Hong Kong, Taiwan, etc., I'm finding more opportunities than threats at the moment. And that's certainly in contrast to swathes of the US market, particularly in some of the technology spaces where I'm finding the reverse. It's kind of interesting where some of the technology listed stocks in China or Hong Kong or Taiwan, I find some of them are undervalued when the reverse is true in the States. And of course, Europe, not the biggest technology player, but with some clearly technology focused exposures, I'm generally finding a few more opportunities than threats, but perhaps Europe's somewhere in the middle, perhaps reflecting its sort of general positioning on many of these issues. So kind of, again, telling me it's very much an active world out there. Of course, the other underperformer so far year to date, or one of the other underperformers, has been the UK. UK was a good performer, one of the best performers last year. But again, you've got to remember the UK market, very relevant for any UK citizen, of course, but from a global perspective, perhaps not as relevant for markets as it as it would have been a number of generations ago. That's just the general progress and shifts of the world, of course. You've always got to remember in the UK market, sector split is important. And the UK market does have high exposure to areas such as commodities, oil and gas stocks, banking stocks and related, among other areas as well. And I find it kind of interesting how some of those sector splits, which were helpful, particularly obviously oil and gas stocks, some mining stocks and related over the last year or two, have been less positive so far this year for many obvious reasons, of course. Certainly oil and gas prices have come off their peaks. Some of the hopes in terms of profitability levels have shifted around, let alone before we sort of start considering shifts in geopolitics and related shifts in the world, general perceptions towards how whether people should be thinking about commodity stocks or not. Some of that has had some impact too, no doubt, year to date. What I would observe, though, is you've had some specific issues too in the UK market. Certainly the UK has had probably the biggest issues with inflation of the most, the top 7 or 10 developed market economies in the world, which has an impact. The UK stocks are not particularly UK focused. I know that sounds a bit silly, but when you think about the fact that large cap stocks often tend to be quite global, that's no particular huge surprise, I guess. But nevertheless, UK assets generally have had some impacts from a bit more of an inflation issue and possibly a perception from that there's going to be a sustained interest rate level impact on UK assets or the UK backdrop, and hence impactful on assets in the sector too, in the country too. Now, whether that's fully reasonable or not is a good debate. My feeling is that certainly from a stock picking perspective, I'm finding more opportunities in the UK among sort of developed market economies, more opportunities in the UK than I can find in any other sort of G7 or G10 country that I could name, which I think is, for an investor perspective, very interesting, or certainly something we'll talk about a lot more in the kind of discussion pre the quarter two earnings season, the corporate updates, which will kick off in mid-July. But year to date, UK large caps have performed dully, shall we say, at best, and poorly in some cases. And I tell you one other area which has performed poorly, actually pretty much whatever geography you look at, but certainly very apparent in the UK, Europe, and the States, and that is the smaller cap zone. Now, small caps mean different things for different people, and certainly a small cap in the States would be that incorrect quotation of mine. The 3 billion size of Apple, clearly it's 3 trillion, but $3 billion market cap is almost a small cap in the States, whilst a £3 billion market cap or euro market cap perhaps wouldn't be a large cap stock, but it would be certainly a company which has a good chance of being a FTSE 100 or equivalent type of sector performer or near performer in sort of pan-European stock markets. So you've got to take that into account a little bit, defining what a smaller cap stock is. But certainly smaller companies, no matter whether you define them as sub 100 million, few hundred million in size, perhaps even in the States, a couple of billion or lower in size. Smaller cap stocks have generally performed quite poorly year to date. And there's always a few reasons for that. I tend to find that during uncertain market periods of time when perhaps markets are becoming more active, are becoming areas where people have to think about matters more carefully, where there is probably a wider range of geopolitical or macro concerns, smaller cap stocks tend to get ignored a bit, or there's less natural liquidity for obvious reasons, and consequently there are fewer buyers, a few sellers at the margin, and consequently the prices come under a bit of pressure. By contrast, you get the complete reverse during more bullish times, more optimistic times, and we've seen that in many previous times over the last 20 or 30 years. I'm not, as I've talked about before, probably, I'm not a particular small cap fan generally. That's not my particular area of individual stock picking orientation. My view for the rest of 2023 would be that I continue to think that you can find plenty of opportunities in larger cap stocks, particularly as it is an active investing world. And I would still be focusing on those areas. It's not particularly linked by the macro or geopolitical concerns and related, which certainly could have an impact. It's actually more reflective of the fact that when we have, if you like, a shift towards what I would call a slightly more normal backdrop of things such as interest rates and to some extent inflation. And I don't see, I think as you've heard me say before, my view on the average central bank out there would be, I would chill on interest rates. I wouldn't raise them any further. Clearly, there's lots of talk at the moment that Bank of England, Federal Reserve, ECB will be raising interest rates further over the next few months. I think that would be an error, and I've talked about that on a previous podcast, as regular listeners will know. But also whether that's a correct call or not in due course. But what I would observe is that because certainly when you throw together the usual lack of liquidity or inevitable relative lack of liquidity in small caps, plus sort of funding structures which perhaps are a little broader in orientation than a typical larger cap company. It's not to say some large caps don't have lousy balance sheets, because plenty do. But just because of the nature and the orientation of larger caps, the higher level of appraisal and analysis and related matters, fewer will quickly fall into sort of a financial challenge, while smaller caps suddenly, oh my goodness, there's a large range of them who have very mixed and dodgy balance sheets, suddenly which go from being lowly valued and sort of understood as a very strange sort of area to look at, but I guess some people find it attractive, but then suddenly come into an uninvestable area, and one where actually, oh my goodness, why are we even bothering this? There's no liquidity, people are going to have to sell and stuff like that. And clearly, that is going to have an impact. And we could talk also about, I guess, the fact that when we see individual investors or even some institutional investors having to redeem money and related, you do, even though theoretically and proportionally clearly it does impact larger caps more, but there's a bit more natural liquidity. We still have a global pension requirement for more general investment selections. I still think, as you know, that too many corporate pension funds have too high an allocation to fixed income. But there are still, at the margin, a significant margin is still being slowly invested into more larger caps of stocks over time. Hence another reason why that 50% only of global markets allocated to the non-US zone feels to me an opportunity over the medium term, particularly in the more developing market zones, because over time it makes a lot more sense for the Indias, even the Chinas, parts of South America, Middle East, Africa, large other swathes of Asia and related, to be a much bigger part of the global markets. This is why I'm kind of feeling that sort of circa 50% allocation of the MSCI index to the States feels too high on any reasonable time frame. Whilst by contrast, when I look at the allocations, proportional allocations to Europe, to some extent to Japan or the UK, yeah, I can see how they could come down a little bit, but not proportionally as much as the US needs to come down. And again, this brings us back to the world of where is the high valuation today. Of course, we've got to think about what sectors are developing for tomorrow and related, and acknowledge the fact that there are some smart sectors in the States, but also in other parts of the world too. And as we've talked about before, yes, technology has performed well in the first half of this year for a number of reasons, be it AI and related new angles and opportunities there, helping certain specific stocks in a particular manner. But I kind of feel that a lot of that has already been factored in now. And actually, I would say the opportunity is more elsewhere. And this allows me to talk a little bit more about perceptions towards half 2/23. I guess it's kind of intriguing, isn't it? When markets historically, when there's been a positive first half of the year, generally the vast majority of markets will end positive for the full year, i.e., if there are any falls or any fallbacks in the second half of the year, it won't generally remove completely all the gains made in the first half of the year globally. That when you look at market indices, be it global ones or be it the US ones that I've seen, that tends to be the case. And I would kind of agree with that. I'm still feeling opportunistic about equity markets if we kind of start there. Mainly because the world, I don't think, it's not clearly in an easy place. We could talk at length about whether central banks are making the right decisions or not. And as you know, I'm a bit cautious on that view. My view would be central banks should hold interest rates over the next 6 months and kind of, I think we're naturally seeing a reduction in inflation in the States, Europe, parts of Asia, etc., which actually will mean that if we keep on raising interest rates in Europe, States, UK, etc., that will actually prove to be too much, hence raising the risk of an unsort of required recessionary period. But we shall see how that works out. What I would observe as an investor is that I'm still finding there are enough companies out there with interesting scope, interesting capabilities. And I come to the conclusion that not all of it is factored in. And it's more in the States is factored in, less elsewhere. And consequently, I'm still sticking with my view that it's a positive, active market out there, which excites me. But hence why the discussion about the upcoming earnings season is so important, because clearly what you choose is going to be much of those sources of those gains. As for fixed income, I'm not. As I've discussed before, I have 0% of my personal pension fund invested in fixed income. You know my thoughts. A smart allocation to fixed income is your age minus 50. So if you're sub 50 years old, so I'm just about still sub 50, you should have no allocation to bonds. That still remains my case. I guess that means as the 2020s develops, I'm going to have a few starter bond positions and related, but hey, that's absolutely fine. There's always a role for bonds and general fixed income, be it government bonds and corporate bonds in a diversified portfolio. I completely get that. However, I can still find more opportunities in equities than bonds. Do I think bonds will largely move out of the sort of the negative total return performance that I've noted in an earlier part of this podcast? Certainly looking at it from, as I am at the moment, in a sterling perspective, the answer is I think it will. I think actually fixed income will perform a bit better in the second half of the year, mainly because that inflation angst sort of element will start to fade away. And even though I am concerned about central bank thinking, and I talked in a previous podcast about how central banks tend to make mistakes by being too slow to raise interest rates initially in the cycle, and then become too sort of aggressive in keeping interest rates too high for too long towards the end of the cycle. And I think that's what we're possibly still going to run into. But nevertheless, because markets look forward, even bond markets, equity markets are quite happy to look forward 12, 18 months. Even bond markets look forward. And certainly, as you know, I'm really focused on things such as 10-year bonds, because I kind of feel for anybody thinking about the bond markets, that is the super most important bond kind of duration to be thinking about, reflecting its sort of medium-term nature. Do I think 10-year bond yields in the States, in the UK, in Europe, etc., will fall, i.e. lower yields, higher prices over the balance of this year? I think they will. I think they will from current levels. And consequently, I can understand people holding fixed income today thinking they're going to make an attractive total return. I think you make an even more attractive total return in a savvy investment selection in the equity markets. But that's been my view for a while. But I think on that basis, global investors should not be holding large amounts of cash. They should be holding assets, and be it my primary focus would be equities, but I could still understand it for bonds too. How about my usual favourite of gold, or perhaps the broader commodities zone? This to me still feels a correct position to be allocated to. As discussed, my personal pension fund at the moment is circa 90% equities, active selections there in a variety of sectors, which we'll talk a bit more about in the next podcast, circa 10% in gold and gold-facing assets. And that to me feels still about right. I am positive about gold. I guess in a way, as I talked about in a previous podcast, gold for me plays a role, I guess, akin to what many investors perceive that some element of fixed income or cash plays in their portfolio. But I think gold actually is a much better way to actually offset inflation, which is, if you think about it, the main role of a bond, which should be, and I think bonds, when you look at them, certainly corporate bonds over time probably do tend to, on a total return basis, do tend to beat inflation, not by much, but by an okay amount, a workable amount. I wouldn't say, I'm not so sure about that about cash. I think cash struggles to do that in my experience. Maybe I'll be proved wrong, but I think when you're talking about pensions and related, as discussed before, it's wise to have a little bit of cash. That's absolutely fine. But when you're talking about your investment selections, I assume you've put aside a little bit of money to be able to pay your bills and have a bit of spare cash just in case you have a new special plan or something within your life style. But when it comes to thinking about your investment portfolio, which obviously is something which should be much more oriented on your whatever your personal sort of age profile is, and hence your pension fund requirement profile, I would always be light on cash. Yeah, it's fine to have some as dry capital, which you can put to work if you're looking for opportunities and the like. But from a medium-term allocation perspective, I don't think it's smart. I think you can find much better things to be doing. And when I think about the rest of 2023, my view on I'm undertaking this podcast on the 2nd of July, so please feel free to critique me at the end of 2023. My feeling would be you will make money from equities and bonds and gold / commodities. Any of those choices, I think, will make you money from here to the end of the year. My favourite still remains an active equity selection, and I've given you some rough views on geography and a few indications on sector split and related, which I'll talk a lot more about on the next podcast. Generally, I think fixed income will perform a little bit better, but not as well as equities. But fine, if you like bonds for whatever reason, you like the diversification angle, that's fine. I do, though, think that you're wiser to consider, again, gold / general commodity exposures. And we've talked before about, from a general commodity perspective, copper et al. There's such an attractive, for me, rest of the 2020s, 2030s orientation there in areas which are supply is not the easiest. Certainly cost control or attractive high quality assets can be, I think, worth probably a lot more than perhaps people are perceiving at the moment. So certainly general commodities, certainly mining sector commodities remains a good component of my personal portfolio. And again, something I'll be talking a lot more about in the next podcast. So I guess what I'm trying to say is half 123 has been workable. Some good things and some less good things in terms of broader performers or non-performers, but I think not impossible for the average investor. And I think overall, if you put money to work on 1st of January, you've done all right. You've done all right, particularly being a little bit more equity centered and a bit more global, I think, on an average basis. And if you're smart enough, I guess, to say, oh, those tech stocks were cheap after the poor performance of 2022, then, congratulations there. I obviously haven't mentioned Bitcoin and the like, but I'll leave that to the real experts. But gold has been all right year to date. And I would still say the gold profile to me is more attractive than the fixed income profile. And that still remains the case. But I think fixed income will probably make a little bit more of a performance comeback in the second half of this year. We shall see on that front. Obviously, a lot of this is centered on the fact that my perception of the geopolitical concern perspective of naturally February, March last year. I think correctly that concern is starting to come down. I think that is correct. We've clearly seen it generally with shipping prices and oil and gas prices and related. But I would say some of the more recent geopolitical concerns, for example, angst between America and China, I think, as I mentioned a few minutes ago, the fact that you've had not just corporate executives from America going over to China, but also the start of more political meetings and related as well, is a good sign. And trade is a win-win for all. Clearly, we can have an interesting debate about where this is going on a multi-year perspective, but from the perspective of the rest of 2023, actually, Greater Chinese equities strike me as actually quite interesting at prevailing levels. Again, you've got to pick and choose carefully. It is an active market, but I would say there are more interesting names than not in that case. And a bit like, I would say ultimately, it's an area which I can see performing well in the second half of the year. And consequently, will it be the worst performing area that I looked at in these graphics that I found on sterling denominated different market zones? I think it's unlikely actually by the end of this year, but hey, we shall see. They've got a bit of catch up to do. I guess, though, ultimately, if I pull it all together, it's not an impossible backdrop. I know it feels uncertain, but as always, as I've talked about before, the darkest hour is always before the dawn. And as an active stock picker, like I am, and as I would sort of, if I had to give advice or observations based on experience of how investors should think, you've got to always spend your time doing your research. And again, we've talked mostly about macro matters. This time we'll talk more about micro matters, stock sector issues and related next time. But you've got to be looking at both. You've got to be spending time understanding what you're investing in, not just flicking the coin and saying, I like this because it sounds good or something like that. And that's true, I think, for all active or all sort of thoughtful investors. Clearly, technical investors, that's a different bag and a different area, and good luck to everyone. I know there are some very skilled technical investors out there, but that's for a different type of podcast and a different discussion, not one which I can really add too much value on. Overall, and I'll end with a final conclusion really from actually somebody who I seem to be quoting quite a lot recently, interestingly, John Maynard Keynes, who once said that it's better to be roughly right than precisely wrong. And I think that feels very apt. And hopefully there's been a few thoughts here which are hopefully going to turn out to be roughly right. And it's always better to have a few thoughtful conclusions rather than just being too conservative or too scared to say anything. So we shall see on that front. Anyway, more micro and sector stock matters on the next podcast. But for the time being, thanks again very much for listening. Hopefully I've said some matters of interest, and I look forward to speaking with everybody next time. Thanks so much for listening, and goodbye.